Welcome back to the Ontario Retirement Income channel, where we help you plan for a secure and happy retirement. Today, we're going to talk about how corporate taxes work in Ontario. Now, this is one of my favorite topics to talk about. In terms of disclaimer, just want to make sure that any information being discussed today is going to be for educational purposes only. Please consult your professional advisors before you implement any of the solution. Now, when you talk about corporations, right, keep in mind we are discussing about the CCPC, which is the Canadian Controlled Private Corporations. Now, when there is a corporation, there's usually two types of income that can be earned. One is the income which is being earned when the company is providing any goods or services. So that's considered as active business income. So there is going to be taxes on those. Now, once you have excess money left over, there's a possibility that you either reinvest back into your business or you go and do some other investments. So maybe you go and buy stocks, bonds, and so on. So that would be the passive investment income. So in today's session, we're going to break it down into the two different types. First off, we'll be taking a look at the active income. So when you talk about active income, let's take a look. We have the federal tax and we have the provincial tax. So the way the tax system is being broken down is into two. So there's a tax on the first $500,000. There's a general corporate rate of 38%. There's an abatement of 10 and deduction of 19. So it means overall, from a federal tax perspective, for the first $500,000, you are getting taxed roughly around 9%. For anything that is over $500,000, same stuff happens, same general corporate rate, the tax abatement. However, instead of the small business deduction of 19%, you actually get a general rate deduction of 13%. So overall, for any taxable income over $500,000, you pay about 15% in federal taxes. Now, of course, we live in a country where it's multi-layer tax. There's also provincial tax. For provincial tax, for the first $500,000, you get a tax rate of 3.2. For anything over $500,000, the tax rate is 11.5%. So keep in mind these numbers is as of June 10th, 2024. If you want to break it down again, for the starting off with the federal tax, the first $500,000, guess the net tax rate is 9%. Anything over $500,000, the net tax rate is 15%. And for Ontario, for anything over $500,000, the low rate is 3.2. Anything over 500, higher rate is 11.5. But what does that look in numbers, right? That's important. So if we talk about let's say, for example, the company has a taxable active business income of $1 million. Going with the same kind of flow for federal taxes, if you notice for the first $500,000, you pay about $45,000 in taxes. For anything over $500,000, you pay $75,000 in taxes. So combined, you're looking at about 120, right? Uh, the other one you're looking at is provincial taxes. So you have first $500,000, you pay 17,500. Anything over $500,000, you're paying about 57,500. So total tax that you'll be paying, federal plus provincial, is about $195,000, right? So you started off with $1 million as taxable active income. After paying off the tax, you are left with $805,000 that is available to either reinvest back into the business, you can reinvest into investments, or you can actually pay some out as a shareholder for salary or dividends. Now, we talked about active income, right? But what about passive investments? There's a possibility that with this retained earnings that is being earned, somebody decides to do some investments within their corporation. So this is where the passive investment income is how it's being taxed. So first, it depends on what type of income, right? So if you talk about interest, taxable capital gains, net rental income, those are taxed at about 53.67%. But keep in mind, out of this 53.67, it gets split into two. So there's a refundable tax of 30.67%. There's a non-refundable one, which is 23%. Now, this refundable tax is also called RDTOH, which is the refundable dividend tax on hand. In the future, if the company were ever to pay out a taxable dividend out to the shareholder, then you will be able to unlock a certain amount from this refundable tax. Now, what if the type of income you earned is dividends, right? So if it's dividends, we can talk about from unrelated companies. So let's say you go and Within the corporation, you go and buy Rogers, Bell, TD, whatever stock it is. It's not an investment advice, but just an approximation. Uh, in those situations, there's going to be a tax on it, and that's a refundable tax of 38.33%. So this amount is refundable. Again, if the dividend is paid out to the shareholder, only then this amount will get refunded. And the refund amount that you will be get it is you will get refund of $1 for every $3 of taxable dividend that's being paid out. Okay. If it's from related companies, so related companies I'm talking about is, let's say you have a holdco, right? And you have an opco, right? So if the opco is paying dividends to the holdco, there's actually tax-free dividend. There's no taxes paid on it. But keep in mind, the holdco should in turn own at least 10% of the voting or the value of the opco shares. Only at that point of time, the intercorporate tax-free dividends is possible, right? So different types of investment income are taxed a bit differently. Now, the last slide we're going to talk about is in terms of the impact of the passive investment income on the active business income. So keep in mind, if you have too much of passive investment income, it will affect your active business income. Because keep in mind, when you talk about active business income, it was divided between the first 500, and then we talked about anything over 500, right? So on anything with the first $500,000, we were able to get something called as a small business deduction, right? So if your passive investment income starts increasing, then the amount of small business deduction, which means the income which is taxed at a much lower rate, uh, will get affected. So how it gets affected? Let's see. So if your passive investment income was $25,000 in the last year, you will still get the full. You'll be able to claim the lower tax rate for the full 500. But if your passive investment income in the previous year is, let's say, $75,000, right? Now, if you talked about uh, the federal tax rates, remember if we talked about the two rates, those 9% and 15%. So if in the previous year the investment income you earned was $75,000, only $375,000 of the active income would be taxed at 9%. The remainder is going to be taxed at 15%. If your passive investment income becomes more than $150,000, if that is the case, then all your active income will be getting taxed at 15%. You will no longer be able to claim this, be able to tax at the lower tax rate, right? So keep in mind, this only is applicable on the federal basis. On Ontario, it doesn't go with these, but in federal one, the amount of passive investment income earned in the previous year can affect on how your active business income is getting taxed this year. So corporate taxes is one of our favorite topics that we talk about with our clients. That's what we specialize in. And there are a lot of strategies which can be used by incorporated business owners to actually take money out on a tax-free basis or take it out at a very low tax rate. So if you're interested in those, definitely reach out to us. You can take out your phone, you scan the QR code. It takes you directly to our appointment page, and we can discuss in terms of different strategies where you can take out tax-free income from your corporation. Thank you and have a good one.